Hello, everyone. Happy Friday. Today on the Final Bar, we'll do our traditional Friday routine, wrap of the week, where we lock in Friday's close, look at the long-term trajectory of the market, see how things have changed. S&P down most of the day today, but recovering into the close, so things holding up okay, but it's all about that key 3,000 level on the S&P 500, whether we're able to remain above there for this week. We're safe. Let's talk about what sector rotation and other signals tell us about next week and beyond. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the day's price action from a technical perspective, look at the charts, see how they've evolved, and especially on a Friday, focus on the long-term trends, see how week to week these trends have evolved. Today, we're also at the end of a month, so we'll talk about how May has wrapped up, what this means for June and beyond. Again, as I mentioned in the introduction, we talked about this S&P 3000 level. We were getting dangerously close around lunchtime today, getting down to those levels, but recovered pretty nicely. So we're going to focus a little bit at the end of the show on sectors and how they've evolved, but also answer some of your questions. Had some great questions into our mailbag about a number of different things, especially about breadth, because we had a number of breadth conversations this week with some of our guests. So I'll get to some of those as well. Just wanted to remind you some of the great other guests we have coming up this week. This week we had Katie Stockton and Ryan Dietrich, who are both just fantastic at what they do. So it was a pleasure to have them on. We're going to continue this positive momentum of quality guests, I hope. Next week, Peter Brandt on June 2nd. That's on Tuesday. On Wednesday, Frank Capilleri from Instinet. The week after that, on June 9th, we have Dana Lyons. And June 10th, Mark Ungewitter. So we got a mix of traders, money managers, technical analysts. It's going to be pretty fun to see how everyone is sort of, sharing what their perspective is on this current environment. Also on Monday, just as a reminder, I was emailing with Ralph Acampora earlier today. We were celebrating our win for StockCharts TV, winning some Telly Awards for recognizing the success of our documentary featuring Ralph's work called 50 Years on Wall Street. And if you haven't seen that, check out on our YouTube channel. It's a really, really cool documentary that our producer Gretchen Pitluck put together. But we were talking with Ralph, and this Monday is his interview on Behind the Charts, which is a really fun discussion about him and how he applied technical analysis, especially during the 1970s bear market. So you're not going to want to miss that conversation on Monday. Let's get to our market recap. So, again, this market this week has been fascinating. And from an academic perspective, I think it's been really interesting to see some sector rotation. I think this week, the real question has been, S&P 3000, where we're at relative to that key level. Also sector rotation. So at the beginning of this week, you had this huge move away from tech and healthcare into things like financials and industrials. Today, by the end of the day, we sort of reversed that. And you can see tech and healthcare at the top of the list today, both up over 1%. Outperforming the market by almost 1% each. And then on the bottom, you had financials, real estate, industrial. So some of these sectors that had done really well on Tuesday and Wednesday kind of coming back down to earth Thursday into Friday. So where does that leave us? Let's look at some of the returns today. We'll look at the charts. And then in our wrap the week segment, we'll really focus on the long-term trends. So the S&P finishing up about 0.5%. Again, almost down to 3,000. I'm sharpening my pencil around midday thinking, all right, this might be the break back below 3,000. It'd be really interesting going into the weekend. Not to happen because we reversed and by the end of the day pushed back above yesterday's close, back around 30.44 on the S&P. Mid caps, small caps both down. So you had the S&P finishing higher, but you can see small caps, even though they came on a little bit in the end of the day, never really near Friday's close, sort of continued the sell-off that we saw going into the close yesterday. So that's signaling some weakness. But the NASDAQ 100 obviously dominated by technology, up 1.5%, really led the way today. The VIX back down to just above 27. Looking at some other markets very quickly, bonds recovering today after last couple of days, a little weaker. So the TLT up 0.7% to almost 164. This is 10-year yields going down around 65 basis points. Around the commodity complex, pretty much positive across the board, including oil, including gold, silver, precious metals. Overall, a pretty decent up move for that area of the market. When we look at a daily chart of the S&P, and again in our wrap the week segment, we'll dig a little deeper into some of these longer term trends. You know, it's all about S&P 3000. You can see on the daily chart, it looks like we just kissed that level and turned right around. So, you know, that certainly becomes more and more valid as a key support level now. You know, when you have a key resistance level like 3000, step one is, can you break above it? We've done that now. Can you close above it? We've done that now. Can you remain above it? And that's the real key. And you get the follow through, but we really haven't had that big follow through push every day. When we have a nice up move, the next one kind of bringing us down, and we're still testing 3000 during the week. So, you know, again, I have to understand the trend. The trend is positive, short term and medium term. And I think the question now is where we remain relative to that key level of support going into next week. You know, looking at sectors, as I mentioned, tech, healthcare at the top, utilities number 3, and we're going to talk, one of the 3 and 3 charts is the relative strength of utilities, because it's starting to come on a little bit. And again, on a total return to return basis, actually pretty decent because of the dividend component to a lot of the utility stocks, but on a price basis as well, actually holding up okay, which is unusual. It's not sort of the traditional offense, but it's coming on pretty well here recently. On the downside, we had financials, and the XLF we mentioned on yesterday's show, if I remember. I think that was one of our 3 and 3 charts with that bearish engulfing pattern. You saw a lot of the big banks sort of suggesting some short-term weakness, and we had a bit of a follow-through with that today. So some of the larger banks that certainly reflect that, but across the board, I think a lot of the financial stocks sort of indicating that as well. In terms of other themes to see out there, you know, a lot of volatility relative to China, and obviously we had a ton of headline risk this week between regulation or proposed regulation on social media companies with relations U.S. and China, between all the social unrest in Minnesota and elsewhere. I mean, our cup runneth over with potential catalysts, and we haven't even mentioned the coronavirus, companies trying to reopen and states trying to reopen, and just there's so much uncertainty with all these things. So focusing on the charts can be really, really helpful right out here. Worth noting that the Chinese markets that have all been beaten down a little bit last week or two have been relatively soft, with the news coming out of there actually jumping a little bit today with the MCHI, FXI, all those ETFs we tend to track, all up 2 to 3%, and other related Asian markets up as well. And the downside is sort of developed markets that underperformed in general, with the UK, Australia, Canada all down a handful of percent. S&P sort of right in the middle there relative to that universe. If you look at industry groups, we talked about the sectors, and it's interesting to see within technology, semiconductors up 3%, so really outperforming. We talked about the relative strength of semiconductors, and I think that remaining positive certainly suggests the potential upside. We talked about KLAC as a good example stock to pay attention to if it's able to eclipse those previous highs. That's something I'll be looking at, but also mobile telecom, which is in communication services, biotech. So some of these groups that have been sort of that coronavirus trade really, doing well related to all of the news flow that we've had, really at the top of the list today. At the bottom, you had things like some REITs, so retail REITs, mortgage REITs, diversified REITs, all down pretty decently, as well as aerospace. And you had aerospace and defense names up pretty good at times this week, with Boeing really leading the way up. Those down today, also banks to finish the week lower. So I think financials in particular, and again, I want to get to a wrap the week, but I think, thinking of an update here, I think the chart of financials is an interesting one. The huge gap up, this is this week, just these 4 little bars right here. And look at how it completely departed from the last month or two, right? We sort of had the big run out of the lows, the consolidation, a gap higher after the holiday weekend. And then yesterday, sort of this bearish engulfing pattern, downtrend day, followed through earlier today, and sort of finished sideways today, but down from yesterday's close. I think going into next week, that's a key theme to pay attention to. Are these financial stocks? It's just a pause before we go on. But overall, again, on a relative basis, I'm still relatively concerned. I think there are other places that have been stronger relatively. We need to move on to our next segment, Wrap the Week. And every Friday, what we like to do is use the Mindful Investor Live chart list, look at how these charts have evolved week to week. And again, now we're at month end, so let's pay attention to the long-term trends. As a reminder, if you've not used this before, if you go to your dashboard, go to your chart list on your dashboard. At the bottom of all your chart lists, there's a little button that says Manage Chart Packs. You can get to all the different chart packs that me and a lot of the other hosts look at. For this particular one, though, an easier way to do it is go to the articles page, go to my blog, which is The Mindful Investor. There's a link right at the top to copy it to your login. We're going to start with what I call the market trend model. This is something I've been using for a number of years. It uses weekly data, and I basically have a simple rules-based system. Long-term, medium-term, short-term are these signals telling me bullish or bearish, and they're all based on PPO, which is related to the MACD indicator. It's using the moving averages, exponential moving averages, to see how these trends have evolved. The 21-week exponential average remains below the 34-week exponential average, which is why on the long-term basis, it's still bearish. And that really is meant to recognize more of the longer-term secular trend. It's been negative since mid-March. I was after the big sell-off there. And that's why overall, it still seems to me relatively limited upside relative to the potential downside. I think we still would need to spend some more time before that turns more positive. The medium-term indicator is based on the weekly PPO, which turned positive first week in May, remains positive, sort of acknowledging this uptrend. And again, right where we're testing the S&P 3000 level. Short-term has been bullish since sort of the end of March when it turned positive, and that's recognizing that big initial thrust out of the low. So the read from looking at this chart still remains short-term bullish. Tactical has been bullish for a little while. Medium-term now turning bullish as well in the last couple of weeks. The long-term trend's still negative. And that, to be honest, that's about how things feel here. There's still so much of an argument to be made for backing and filling, for retesting, not the lows. I think that's less and less likely, but getting down and retesting some of these ranges in the 2,700 S&P, if not a little lower, I think is still reasonable and will still fit into a long-term transition period. The daily chart we talked about, again, what I have for a while been sort of saying bear market rally. I think, we're nearing an end. We continue to go higher. So again, as a trend follower, I have to acknowledge that this has been an uptrend. That's why the model being positive on the short term and medium term makes sense to me, and I'm okay with that. And I certainly have seen these opportunities for the market to turn lower have resolved to the upside. Until we stop making higher highs and higher lows, you have to acknowledge that the short term, that tactical trend remains positive. We have now broken above that S&P 3000 level, which I've talked about, the RSI above 60. So this is showing the characteristics of a bull market phase on that cyclical time frame. And I think you have to acknowledge that's where it is. There are lines in the sand that if we start breaking lower, I think you could suggest more of a rotation down. But at this point, I feel pretty comfortable being more on the long side than the short side for sure. When we're looking at breadth, that's one of the things we've talked about, the changing breadth characteristics. Some of the questions a little later are going to be related to breadth, but in particular, the cumulative advanced decline lines have now broken back positive in some cases, and I think this is really important. Out of the four that I'm looking at, the mid-cap index, I'm probably going to flip more to a greenish color because it's broken above its swing high from the end of April. If you notice, and this is not updated for today's close quite yet, so I'll see over the weekend how this looks, but I would want to see each of these break above their swing highs. We've not seen it yet with small caps, not seen it yet with large caps, and also not seen it yet with the overall broad New York Stock Exchange. When that would happen, I would sort of color code these green, suggesting a move to new swing highs. I'm pretty comfortable with the mid-cap index suggesting that. But they're at key levels, which is interesting as, again, stocks in the technology sector and others sort of testing those huge resistance levels. We haven't seen a ton of new highs yet. We're seeing a token amount, but again, the average stock is still within this range. I think charts like KLAC, I keep mentioning because they're stocks that topped out earlier this year, have now round tripped after selling off in February to March, have now come back and are retesting those highs. You need to see stocks like that breaking to new highs, which would push these green bars higher, showing you more 52-week highs on the New York Stock Exchange and in the S&P. We haven't seen enough of those yet to really say it's an all clear sign we're going higher. That's what I would want to see on that particular chart. This one we talked about a lot with my guest Ryan Dietrich yesterday, and with other guests this week. So I don't want to beat this one too much, but overall we have gone from 0% of the S&P above their 50-day to over 90%. That's actually pretty common for the beginning of broader bull markets. And most of the time, what Ryan was showing us yesterday is that almost every time 12 months later the market's been higher in that configuration. So certainly speaks to the internal strength of so many stocks recovering their 50-day moving average. We talked about sentiment earlier, so I'm not going to hit it too much. With ratios, I'll just touch on a couple of these. With consumer, we've seen this rotation to consumer discretionary from consumer staples. That trend still remains relatively positive, pull back a little bit at the end of the week, but overall still leaning more towards discretionary, which makes sense. Semiconductors, near a new relative high, but not making it yet. Teased it about a week and a half ago and now has pulled back a little bit, but overall the trend remains positive. I'd want to see that continue to remain strong. I think one of the more key ratios to pay attention to is this one, small caps versus large. This has been such a relative underperformer, right? In general, owning mega cap over small cap has been the trade for a while. That all has changed since the market bottom. Small caps have been outperforming, and that's starting to actually gain some steam. Some of the days this week, you really saw an upthrust in small caps. Did not happen today. You saw small caps pull back a little bit while large caps finished in the green. But I think this is a trend to really pay attention to, because I think a lot of people have gotten very comfortable owning those big mega cap names. If this continues to change, you're going to hurt yourself if you're not getting a little further down the cap tiers and looking, especially screening for opportunities down in the lower end. And then finally, this is another one I want to hit on, growth versus value. And again, I've had questions about the end of the growth trade and the reemergence of value so many times, and the trend continues positive. So I've been hurt before by this ratio. I'm hesitant to tell you that it's changing. This pullback looks really similar to the pullbacks we had in March and in April. But again, if we make a lower high, which is what we've not really been able to do, we keep reversing higher. If we get a lower high and continue this trend downward, maybe this breaks below the 50-day average for the ratio, I think that would be a really important one, because a lot of people, I think, mentally have written off value as well for a very good reason. But if that changes, you want to pay attention to it. We're going to take a quick commercial break, back actually sharing with you something that's happened in the world of Bitcoin you probably don't know about, and you probably should. We'll be back in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at stockcharts.com. As a reminder, send us your questions and feedback anytime. The Final Bar at stockcharts.com. We don't talk about Bitcoin a ton on this channel, but it's an interesting event that's just happened called the Bitcoin halving. Happened in recent weeks, and it's actually an interesting structural change in Bitcoin that has traditionally materially affected the price. So here's a quick segment we put together explaining Bitcoin halving, what happened, and why it's important for you. Here we go.
On Monday, May 11th, 2020, a Bitcoin halving occurred. But what exactly is a halving? New Bitcoins are issued by the Bitcoin network every 10 minutes. For the first 4 years of Bitcoin's existence, the amount of new Bitcoins released every 10 minutes was 50. Every 4 years, the number is cut in half. This day is known as a halving. 2012 was the first halving, which dropped the amount to 25. In 2016, it went from 25 to 12.5. And most recently, in 2020, it dropped from 12.5 to 6.25. This process decreases the amount of new Bitcoins generated per block, which means the supply of new Bitcoin is lower. In normal markets, lower supply with heavy demand usually leads to higher prices. Since halving reduces the supply of new Bitcoins and demand usually remains steady, the halving has usually preceded some of Bitcoin's largest runs. In this image, the green lines indicate the previous two halvings in 2012 and 2016. Note how the price has jumped significantly after each halving. The Bitcoin halving schedule is determined in block height, not date. Every 210,000 blocks, a halving happens. The 2020 halving occurred on block 630,000. And the 2024 halving will happen at block 840,000. There are 21 million Bitcoin in existence, and it is expected that they'll be mined by 2140. More than 98% will be mined by 2030.
So that is Bitcoin halving, what happened and why it's important. Again, as a technical analyst, I have found that focusing on the price is certainly the primary role of I think, the technical process. And I think you certainly want to understand the trends in something like Bitcoin, especially as you're thinking from an asset allocation perspective. There could be a role of digital assets into an asset allocation exercise for sure. But besides just looking at the price, understanding some of the structural changes can be really helpful. And that's where I think something like Bitcoin halving, it's best to just understand as much as you can about it. Let's get on to our next segment, the Final Bar Mailbag. As I've mentioned a number of times before, I love the interactive nature of the show. It has been such a pleasure to get to know so many of you through your questions and your feedback, very thoughtful feedback on the show. I apologize for shaving off the coronavirus, separation beard. That went away about a week or two ago, so sorry for that. I did receive some comments. I appreciate you noticing. But honestly, let's get to some of the questions that you guys have sent in, because they've been actually really, really good. And some of these with some great visual aids to go about it. First one, I've created my Canadian morning coffee routine, which is fantastic. I always hope someone will take something like that I put together and adapt it for their own purposes. So I'm thrilled to hear that that's something that you've done. Well done. You included this chart, and to summarize your question, and sorry if it's a little busy, I'll try to just orient you to it, but basically applying that same breadth mechanic that we talked about with the S&P yesterday with Ryan Dietrich and applying it to the TSX, so applying it to Canada instead of the US. And the question is, what does this mean? If you look at the breadth in prior downturns, the current breadth situation looks actually fairly negative. And I think what you're looking at is the extremes in breadth, and you're highlighting some of these divergences that have come at previous tops. So here's the way I would think of it, right? So divergences are something totally different, right? So we've spiked, and again, similar to what you saw in the US and the TSX, from 0% to over 90% above their 50-day moving average. That's very, very similar. For a divergence, you would need to have some of these things that you've shown here. You would, have a pullback of some sort, and then the next move higher, you'd have a lower peak. So, the next leg higher, price goes up, less breadth on the on these readings. I could see that being a negative thing, but we're not there yet. At this point, we're more at the initial part of that move. And if you look back at when you've been down to the zero level and have gone up significantly, I would bet it's similar to what you saw with the U.S. market, which is after that, it actually tends to be fairly constructive for a while. So all this tells you is a lot of stocks have rallied a ton, and you're seeing a similar thing with the percent above the 200-day, the percent above the 150-day you have here as well. I think it's a similar characteristic. So having not looked at Canadian market history as deeply as I can't say this with 100% certainty, but I would assume, based on the breadth characteristics I've seen looking at the U.S. markets for many years, this looks very similar to what you saw in the S&P, which actually is long-term bullish for the markets. The divergence would tell you that there's some inherent weakness, and that's what I would be looking for relative to your chart. I think you've highlighted some of those historical divergences actually very, very well. Well done with that. Question number 2, one of your guests talked about stochastics. I think that was Kim last week. Kim Sokoloff was talking about stochastics, and Katie Stockton actually this week. I don't think she had them on her chart, but she uses them pretty often. How does this differ from MACD? Which of the two would you recommend? So, right, so I use the PPO in a lot of my my charts, and I'll quickly kind of jump these around. I use the PPO, which is kind of like the MACD. I mean, they're very similar. So the calculations are a little bit different. Stochastics is a very different beast. What stochastics basically does is it tells you where are we at versus the highest high and the lowest low for the last X number of days. So if a 14-day stochastic is at 90%, that means if you look at the highest high and the lowest low for the last 14 days, we are 89 to 90% of the way up through that high to low range. So it tells you where we're at relative to a historical range. RSI kind of does something like that, but its calculation is totally different, just using the closing prices. So stochastics is a great way to understand short-term swings. So if I was a swing trader and wanted to be sort of playing this move in United Healthcare, you can see how stochastics is actually really good at picking out some of those price swings. And Kim Sokoloff, my guest, was actually using a shorter term version of the stochastics to do that exact thing. For me, I tend to look at the trend. I'm less trying to pick the swings. I'm trying to understand the overall trend. So MACD is more of a trend following indicator. I think of stochastics as a little more of a leading indicator. MACD is a little more of a trend following indicator, and I use that to confirm the uptrends and downtrends. So calculation is very different. The idea is similar in that you're trying to understand trends, but I think it's whether you're leading by looking at momentum, which is what stochastics does, or you're lagging behind being a trend follower like MACD does. If everything I just said was too quick, too much, I'm so sorry. Go to our chart school. We explain them in a little more detail. Could help you. Next question. Nail the it's a leveraged ETF. Yeah, the 3 times bullish home builders and suppliers from Direction. NAIL is the ticker. Approximately 43% of the stocks in the ETF are above their 200-day moving average, yet the ETF is 50% of the 200-day moving average. I see. You're showing the value here. So you're basically saying this ETF is below its 200-day moving average. If you look at the stocks, about 43% of the members of this ETF are above the 200-day moving average. That means the other 57% of the stocks on the ETF must be doing poorly. Interesting question. I will try to summarize what I think you're asking. You're using this to understand home builders as a whole, and then you're looking at the components, the stocks that probably make up this index, and then seeing what percent of them are above their 200-day. And because X percent are above, you're thinking the other remainder are probably below. Your logic is pretty sound. However, you're missing one point. You're using the triple leveraged ETF, which means if you look over time, this becomes more and more disconnected from the actual home builders index, because you're matching triple the daily returns of something like the XHB. So if you look at something like the XHB, I think this is probably a better proxy for the member stocks and kind of where they're at. This is actually right at its 200-day right now. And so that makes sense that it's kind of 50-50, because I think half of them are probably above and half of them are probably below. You can't do breadth like that with a leveraged ETF, because the return streams become disconnected, right? Depending on the day-to-day turns, over a long term, the percentages can be very, very different. That's why, honestly, they weren't designed to be held over the longer term, because the percentages are a little more unpredictable. So that's kind of how I would answer that. I hope that answer made sense. But you leverage ETF, difficult to make that conclusion. Do that same analysis, but swap in something like the XHB or the ITB, sort of a home builders ETF that is unleveraged, and then your analysis is going to make a little more sense, I would say. That's all the time we have for our mailbag segment. We received some other great questions. We'll get to them at the beginning of next week. And again, thanks so much, everyone, for sending those in. Really cool to hear from you, and good to hear what questions you are trying to answer in your own process. I am told to move on quickly to the 3 and 3, and we're doing it right now. It's just more of a sector focus today, because I was digging into some of the sectors before the show, and I caught some interesting things. The first one is consumer staples. And again, I feel like I had been talking about this sector a lot because it rallied so well in the market sell-off. And back here in March, I feel like I was talking about staples a ton, because it was General Mills and Campbell's and all these names that were just ripping after being sort of a yawner for so long and being consistent underperformers. The relative strength accelerated, but then they gave it all back as things like tech, consumer discretionary, healthcare emerged as new leadership. It is still way too early to say that there is an emergence of relative outperformance. These things are still underperforming and the trend is down. So don't get me wrong there. But I think it is worth noting that this sector has rebounded, has broken above its swing high there from mid-May, proceeding more to the positive side. And now it's testing its 200-day from below. So it would be interesting to see, given a market pullback, if that's what we see, if staples are able to hold up okay and start outperforming. If not, though, again, I think you have to go with what's working on a relative basis. But this is one chart that's improving on a price basis, which is why I would want to watch it. Speaking of something improving on a price basis, technology has been consistently there. What concerns me with the chart of the XLK, you think about the S&P 500 testing that 3,000 level, has broken above it, but just has not had that huge upswing afterwards. Every time you want to just feel long and strong, S&P is going to new highs, we sort of pull back a little bit like we did today, and we're sort of just digesting that breakout. The XLK, and especially a lot of the components, and it's the big names like Microsoft, it's semiconductors like KLAC, it's other industries within tech as well. They're all really, really close to that huge resistance from the January, February highs. Some stocks, the configuration looks a little different, but I think with the XLK, it'll be really important to see if it's able to, as we get there, it's a question of limited upside, right? 102 is pretty close to where we're at. But again, if the relative strength continues, I think you want to be in a place like technology until it starts underperforming. Utilities are emerging, and actually they're one of the better sectors today. The relative strength coming up a little bit more than consumer staples. Still, overall, it's been relatively challenged, which is totally fair because it's been pulling back as other parts of the market have held up. But again, rotating higher. It's had a good couple weeks on a price basis, and I think as this price would continue higher, if it's able to test that 200-day, you could see the relative strength start to improve. And then I think that's when you have to consider something like utilities, especially with the dividend component. Don't forget that total return aspect to the dividends and the income that could potentially generate. Folks, that is our show for the day. That's a wrap for the week and a wrap for the month of May. Are we having fun yet with the volatility in the market? So many cool charts to look at together. I'm excited to keep it with you in June and beyond. Get your questions to us at the Final Bar at stockcharts.com. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.